everyone in this extraordinary edition of the Shortest Institute. Due to the current situations, a lot of people asked me what's happening. We need to talk about the uncertainty of the money. So that's why I brought you this live session, which I hope that we can make it interactive. I'm telling a couple of information, the patterns, what's happening usually in these uncertain times, but I would like to encourage everyone to make it as interactional as possible. So please, at the end, we will have a lot of time for questions, answers, and if you're watching this on a demand, you're watching it again recorded, then please reach out to us. It's very easy to find us, and please continue the conversation because that's the only way that we can create a ethical and transparent industry when everybody understands how banks think, how money moves, and why certain decisions are made globally. So today's topic is the war, the sanctions, and the banking. How safe is our money? Unfortunately, global tensions, sanctions, and banking disruptions are no longer just theoretical risks. And the last week, we have seen that the whole world exploded, and it doesn't matter which part of the world you are, you're just watching the news. And if you have an international business, you've got companies all over the world and trading internationally, as we all do. Nowadays, we are no longer just local. Of course, the panic kicks in. What's happening with my money? How safe is my money? What can I do? And it's very important that we are not only talking about what can we do today, but what can we do to avoid panic situations like that when you wake up with a cold sweat at the middle of the night that, oh my God, I have not done what I could have and should have. So let's go through a couple of points. And I think it's very, very important to understand the underlying rules, how banks work, how banks think, and then you will be able to make better decisions in certain emergency cases. So I brought you a couple of points which I want to discuss today. The first one is about how important is to plan for your banking and payment routes as well, not just for taxes. And I have seen so many times on the Instagram or everywhere you go, you've got an accountant, you've got a lawyer. They say, yeah, don't worry, incorporate an offshore company, and then you optimize your taxes. I mean, I'm a tax advisor myself from the past, so I know exactly how it works. But just because something is legal and you can do it, it doesn't mean that the bank wants to work with you. So it's very, very important that you, even though that you spend month and month and money to talk to the accountants and tax advisors and lawyers to design your tax structures, you still need to consider how viable it is, how the money will actually move, because the structure might be absolutely perfect and you might have a legal opinion and you say that, hey, but I'm legal, everything should be, happening for me. But still, banks have a different logic. Banks have a different risk appetite and the risk scoring than just, you're legal, then off you go. And one thing I have seen a lot, and mainly when we are talking about international money movement, is the question of the substance. Yes, you can set up a company abroad and even run it, but why do you have a company in a lower tax jurisdiction and pay less taxes if you're living in another jurisdiction where you should pay more taxes, right? So this tax, obvious blatant tax avoidance might be good, looking good on paper, but obviously the banks are there to filter out people like you, to stop people like you cheating their taxes. So if you think about, banks are the policemen basically of the economy. The banks should filter out that what could go wrong. Is there an opportunity for you to optimize your taxes in a way which not might be actually not the right way? and filter out these activities. So it's like super important to understand, just because you have a solid tax planning structure, it doesn't mean that it's also good for banking. It doesn't mean that there's going to be payment and banking providers who want to work with you. And it doesn't mean that your money is safe. And I think today's environment, this is also one of the most important thing, that how safe is your fund, how safe your money is. Optimizing taxes is one thing, but spending on banking and risk and eliminating problems and firefighting later and making panic decisions could be so much more expensive than taxation. So just as important that you sit down with your tax advisor, accountant or lawyer, sit down with an expert on payments and banking, the international payments and banking expert, then plan your flows accordingly, because it doesn't cost a lot to do it, but it can cost a lot not to. And when you have to pay money on the firefighting part. The second point that I wanted to mention is the sudden and unexpected changes. Because even though you do everything, you sit down with your international payment and banking expert, and you're planning for things, there are some times in life when the market, the geopolitical the outcomes, the results are completely working against you. And I brought you a couple of examples. For example, a couple of years ago, when the Russian and Ukraine war erupted, all market experts expected the Russian currency to collapse, obviously, right? Because the Western sanctions froze a large part of Russian foreign reserves, and several Russian banks were cut off from the SWIFT system, the global messaging system. I think we all remember that. So we expected that the ruble will immediately crash and then stay there. And it happened, yes, it was crashing immediately after the sanctions, and it lost roughly half of this value within days. But then something unexpected happened, because the central bank of Russia imposed very strict capital controls. The capital controls are the cases when you're unable to send money out of the country without justification, without approval. We see a lot, for example, in China. We had capital controls in Nigeria as well, and definitely, Russia, to save the economy. Lebanon, for example, to save the economy, the banks keep the money within the country, and that's what happened when the central bank of Russia started the strict capital controls. And they also raised the interest rates very sharply, which was obviously motivating the individuals and businesses to keep the money within the country. So all the Russian exporters were required to convert their foreign currency earnings into rubles. And also the individuals were limited in how much money they could send abroad. And at the same time, Europe still continued purchasing all the Russian energy during the early phase of the war. And this created a shortage of the ruble in the market. So the demand increased. And as you know, the demand increased, the price increases too. So all the traders who had bet against the ruble eventually had to buy back to close their positions. So in a few months, the ruble became one of the strongest performing currencies in the world. And obviously, no one expected that. At one point, it actually traded stronger than before the war. And this surprising element was not only the recovery, but the speed of it, right? How quickly it actually happened, because a few analysts expected sanctioned country to produce a temporarily stronger currency through capital controls and commodity revenue. So that was a very interesting case. But that was another one in Kuwait back in 1990, when Iraq started a conflict with Kuwait and invaded. And the country, when the country is occupied, obviously the normal expectation is that the currency collapses and obviously disappears. But Iraq replaced the Kuwaiti currency with Iraqi dinars, and they looted the large quantities of the Kuwaiti banknotes from the central bank. But again, something happened which was very surprising for the economists, because the Kuwaiti government, while they were in exile, they worked closely with the central bank of Kuwait and foreign partners, and they invalidated the stolen currency. So later in 91, Kuwait issues a completely new series of banknotes and declared that the stolen notes are absolutely worthless. So instead of collapsing, the Kuwaiti dinar regained its value once the government returned and the oil export resumed. And the confidence returned because obviously the state maintained the international reserve and institutional credibility, even when the country was occupied. And this just shows that the currency survived despite the temporary disappearance of the state itself. So it was a very, very interesting case. But there is a third one that I brought today, which was the hyperinflation in Venezuela, because back in 2013, when Hugo Chavez passed away, Maduro took over, and Venezuela already had a currency controls because they already have some issues, and the strong government involvement in the economy. But what happened was absolutely shocking because the bolivar, the Venezuelan money, entered a hyperinflation cycle when the prices began doubling within weeks and actually within days. So the banknotes became completely worthless. So what people started to do? They started to use the dollar across the country. They adopted the US dollar as their main official currency. And even though the foreign currency use has been restricted for years, all the businesses and citizens started trading and even pricing their services and goods in dollar. And it is a very interesting case because in this case, the dollar became the main currency of a country without any official policy change. And this situation just shows that how quickly a payment system can change when the confidence of the local currency disappears. So these changes just get to show that there are a lot of unexpected changes. Of course, we can't get ready for everything, and things can change within a minute. As you can see, last weekend, we had no clue that we're going to have these issues a week later, unfortunately. But what you can do as a business owner, moving money internationally, is just to get ready for the unexpected and try to think outside of the box, and try to estimate the risks, not just, oh, it's a bank, it's safe, and we deal with it once we get there. The third part that I wanted to talk about is how dependent we are on the correspondent and intermediary banking. Let's say that you want to send some money to your friend, let's say in the Philippines. Let's say that you're in Germany, right? Obviously, the German bank branch, which is down there on the road that you're walking in, has no direct connection with the Philippine bank branch of your friend in that village that you want to send the money to. So it has to go through some route of international correspondent and intermediary banking. So usually it happens that there is a bank, the sender bank in Germany, in the whatever branch, that sends back the money to the headquarter, that sends the money to some correspondent bank which has relationship with both of the recipient and sender bank. Then the receiving bank gets it, then it sends it to the local village of your friend, then your friend is actually picking up the money. So it's a long, long way. And most of these international payments depend on correspondent and intermediary bank network. But where are these banks? It might not be in Germany nor in the Philippines. It might be in the US. It might be in Hong Kong. It might be at the Middle East. So if one correspondent bank fails, then several banking routes failing at the same time. And it is not public information. So there is no one country in trouble, but I'm safe kind of approach because everything is interconnected. And there was an interesting case again, going back to the Russian war, because many companies outside of Russia believe that we're good, we're golden, we're not affected because we have nothing to do with Russia. But actually, Russia, being the size of it is and the importance in the global financial system, even though that banks were located in Europe or Asia, after the sanctions were imposed on several Russian banks, companies in Germany, Netherlands, Turkey, and various other countries all reported failed transfer to partners, for example, in Kazakhstan. And the issue was not that Kazakhstan itself was sanctioned, but the actual payment route was closed. Now, how does it affect you? delays in the transfers. You can pay your suppliers later, you pay your salaries later. Obviously, liquidity problems if you can't pay anyone, not even later, but ever. Um, Costs, that could be different costs because now the money doesn't go through this way but that way, and the bank is sending you a letter of the changed costs. What are you going to do? Question it. So always have this in mind, that you do need to have some kind of buffer in terms of time, in terms of pricing, because this could easily happen with any kind of intermediary bank. So, for example, there was a banking crisis back in 2013 in Cyprus. And even though Cyprus is such a small little island in the Mediterranean, many international companies were using Cyprus as a financial hub for operations in Eastern Europe, Russia, and the Middle East. So all businesses in like Ukraine, Russia, Greece, and the UK had some kind of eyebrow raised that, okay, what's going to happen with our money? Because the banking system suddenly experienced payment delays without even knowing that things are going through the Cyprus banks, because their counterparties were using Cypriot banking infrastructure. So even a tiny little tiny little island's banking crisis can have serious effects. And as I said, it's not really the public information, because if I'm going to my bank, that bank at that given moment decides where is the best routing. But obviously, who's going to pay for it? Me. The fourth point that I wanted to bring to you today is the actual infrastructure, because we are talking about online banks, we are talking about money movements internationally, but these are still running on actual data centers and servers and trading floors and telecom network, and the internet has to go through some kind of wire at one point before it gets Wi-Fi. There are still a lot of countries, mainly islands, who are getting the internet in a big wire under the sea. So when there is a problem, when something gets bombed, that means that it can really seriously affect the infrastructure, and the infrastructure is not there. You just simply can't send money. So the access to money also depends on the infrastructure, the political stability, central bank reserves, and obviously, the telecom and the payment networks. Quick question for you. What happens if your main bank's headquarter gets an attack, unfortunately, and you can't access your funds? How long can you survive? Let's say that tomorrow never happened. I hope never happened, but just play with the thought, just play with the idea in terms of risk. What is happening if you wake up tomorrow and you can't log into your net banking? You can't see your balances because that data center was unfortunately bombed. It's horrible to think about it, but as a business owner, you do have a responsibility, and it's important to think of this. One example: September 11, back in the US, the attacks directly affected the infrastructure of the US financial system, because the financial district of New York was actually concentrated in this very small geographic area. So the data centers, the trading floors, the telecom networks, and the clearing infrastructure around the Wall Street were all damaged or inaccessible. And several large banks and brokerages had offices in the towers or the nearby buildings. So that's why it was very damaging as well. Obviously, after the very unfortunate events, and obviously losing life, which is horrible, but the infrastructure also got damaged, and for several days the access to certain banking services were limited, and even the New York Stock Exchange was closed for 4 trading days, which was the longest closure since the Great Depression. And that just happens one day to another. So payment clearing networks had to reroute the operations. This increases risk, this increases fees, this increases timelines. So it can happen anytime. So what can we do? Contingency planning. Very, very important. You need to see how it looks like from a bird's eye perspective, how you can diversify the risk. What are the routes that your payment is taking, where the money comes from, how much, how often, what currency, how this currency is affected, because you might actually trade in Hong Kong dollars, nothing to having Hong Kong, but in case something happens in Hong Kong, the Hong Kong dollar itself, which is the basis of your trading, going to have an effect. So you do need to see everything in a larger perspective. You need to see how you can diversify certain risk. You need to see how are you rerouting certain payments flows. You need to see what are these multiple layers of these providers. Just to give you an example, we had a client who thought that, well, I'm diversifying my risk. I've got 5 different payment providers. He didn't know that gateways are usually, and payment aggregators are aggregating someone else's service. So when we are talking about, for example, white label providers, software as a service, if you're adding a financial license on top of the software as a service, SaaS, it becomes a BOSS, banking as a service. But they are obviously using another bank's infrastructure, compliance, onboarding systems, record keeping, data security. Obviously, they are using the financial license of another financial institution. So that financial institution is actually, executing all these transactions. And the front end, what you see on your mobile application or you see on your, I don't know, marketplace embedded finance, it is actually an underlying financial institution at the back who is creating all of these transactions in real life based on their own license. So what I'm trying to say is there is an inception of payment because the bank is selling their services like uh, like a manufacturer selling it to a retailer for in bulk. So the payment gateway can aggregate that and resell it, and then they are reselling it, and they're reselling it, and they're reselling it. And the payment gateway is selling a payment gateway, is selling a payment gateway, which is selling an acquirer, which is connected to the intermediary bank. So everything is connected, and it just one little mistake and then the whole system can collapse. So what happened with our client? They thought that we've got 5 different payment service providers. Turns out that no, they had one. One acquirer was selling their services to that payment gateway. It sold it under the name of whatever pay on whatever fee. And then there was another gateway, which again used the same acquiring service, and they sold it under B Pay. And then B Pay was charging costs B. And then there was C Pay, and they were charging costs C. So on a surface, it looked like that I'm diversifying and I'm having my money kept with different banks and financial institutions and neobanks and payment providers and payment institutions and whatnot. But at the end of the day, the underlying bank was actually the same. And even though the client was paying different fees, different terms and conditions, it was the same provider at the end of the line. And this is very important when you're trying to evaluate your risk and you're trying to do contingency planning. And that's what we see that, for example, when Silicon Valley Bank collapsed, how the effect reached even Europe and Credit Suisse, for example, because everything is interconnected. So contingency planning is only good and only useful if you're not only doing it on the surface. Ask questions from your banker. Who is your other bank? So, for example, you've got a European bank in a euro account, most probably they are managing it, but who is providing them the dollar rails or the Hong Kong dollar rails or the pounds, right? Most probably the pounds are coming from another bank in the UK, right? So it is important information. You don't have to map out everything, wish we could, but at least ask those questions to set up a proper contingency plan. Otherwise, you might actually keep your money with the same bank through multiple intermediaries, which is obviously not the best. Um, but it gets back to the point that the bank's job is very, very hard. As we mentioned, that banks are the policemen of the economy, and since you can't put a policeman next to every single individual, the government is enforcing policies and economic decisions and effect on the economy through the banks. Increase the interest rate because then people are saving money in the bank. Therefore, the economy is moving in a certain way. Now, obviously, I'm bastardizing it because there's a whole industry around that called economics. You go to university and you study it for years. But the basic understanding is that banks are the enforcers of all the fiscal and monetary policies and government decisions and economical maintenance, which is decided on a government level. So banks' job is hard because they are getting the penalties for any mistakes that they are doing. They risk their license with every single transaction. They risk they have a penalty if they don't disclose something. They don't keep the notes. That's why banks are nagging you all the time. Give me the document, scan your passport. What's the reason for this transfer? Because they need to make sure that they are doing the utmost everything in their capability to filter out all of those creative individuals, money laundering operations, illegal transactions that should not take place in a healthy economy. That's why, for example, banks hate cash. Not because they want to control you. Yes, they want to control you because if you are sending cash to your friend, no one sees that you declared it, you pay taxes on it. Is it even for legit transactions? Are you buying legit services and products, not illegal ones? So that's why the government is trying to maintain a healthy economy and a healthy society through enforcing decisions through banks. And as you know, you're just as good as your weakest link. So imagine if you're running a bank which has branches all over the world. There is a teller in the middle of a village, in a remote village no one even heard of. If that teller is saying yes or accepting money or executing one transaction, that can affect the whole bank. And that's why banks are trying to play safe. So that's why you see that there are some blanket decisions, mainly in times like this. Okay, we are not dealing with anything coming from whatever country. We are not dealing with this currency. We are not even risking something goes wrong. So even if you have a legal and justified operation, you can easily have a no without reason because banks are private institutions. Often they don't even have to justify why they are saying yes, no to something. And they have a very conservative risk policies because I'm not going to risk my whole operation so you can send your 200 euro to your friend somewhere which I think might be sanctioned or might be dangerous for me, even if it's not. Banks are making blanket decisions to safeguard the status quo, and it applies to all the clients and all the cases without individual checks because it's also very expensive. So if you think, but I'm going back to the banker and I can convince them and this is my legal opinion, you might actually not worth it. How much is the banking fee that you are actually spending on the bank to make the decision so you can transfer money versus the stress, the risk, the record keeping, the convincing of the officer and the manager and the compliance of your transaction might just not worth it. Rather than risk it, rather say no to everything. So this is when we see that entire sections, regions, currencies can be restricted even when the activity or the companies are completely legitimate. And yeah, sanction enforcements are also changing on a minute basis. So good luck for a bank to figure out that right now there are capital controls in Lebanon, there is a currency control in Nigeria, there is a war in Afghanistan, and how does it affect me as a bank from a risk perspective? It is a very, very hard job what banks need to do. It's not fair, yes, but unfortunately, these are the circumstances that we are living with. So, what can you do? Well, we developed an 8 step, easy to follow, regardless of the size and the activity of the company. It's a very easy to follow 8 steps of a framework, which is putting things in perspective. You can find more information on our website, but it's very easy to find it as well through a simple Google. It is called the Shortest Payment Framework. And the 8 points are: collect the information, get all the information what you need, because that's the first step. What are the documents? Who are we having contacts with? Who are our counterparties? What companies do we have in a group? Collect the information. Second, create a visual group chart. Put everything in a bird's eye. You see what's going through, where the money is coming from, who is holding our funds, what transactions are done, what are the routings, what currencies we are using, how the money is leaving the operation, where do we pay the supplier, the salaries, the manufacturer, the what. So you see everything in one go to have better understanding of the opportunities, the bottlenecks, the restrictions, the inefficiencies, the double usage of certain providers. So it put things in perspective. Third one, understand the relationship between the companies and your key personnel. And mainly when we are talking about international business, is super important. Who is the director who is making decisions, and who are your shareholders who are benefiting from the business? Because if that individual is sanctioned, is from a country which is sanctioned, or getting under this blanket decision, or getting a bit questionable, not the person itself, but their nationality, their source of funds, their residence, for example. Someone lives in a country, then it's not even from that country, but the bank could have some questions about it. Oof, we should rather not deal with that country. Then you do need to know about that, because it can affect everything in the group. And then you might think that, oh, but I have a company in Singapore, one in Dubai, one in France, and one in the US. Yes, that company in Dubai might affect the company in Delaware as well, for example, because the banks need to see how the funds are flowing and what is the actual source of funds, going back steps and steps. Um, Fees and taxes. Obviously, everybody's talking about fees, but you have to see the taxes versus the payment flows and the banking decisions. This is what we talked about at the beginning. Fifth step, terms and timelines. How quickly your money moves. The longer the money is in someone else's pocket doesn't mean it's your money. There is a risk. If the payment provider settles you once a week, you who don't have access to your funds once a week, it accumulates somewhere else. More money you don't have in your pocket, the more risk you face. So you do need to understand how the money moves, but how quickly that money moves, and what can you do to speed things up, because a couple of days here, couple of days here, couple of it adds up, and you might actually pay for something that is not even necessary. Six, hedging and foreign exchange. And it's super important, mainly in international companies. If you don't take anything away from this live, ask yourself or your CFO, or whoever is making decisions on your payment today, one question: who is doing the foreign exchange? Because if your high street bank is doing the foreign exchange, there is a cost inefficiency. I'm telling you right away. So that's a given. Foreign exchange, hedging, super important, mainly when you're dealing with international transactions. Number seven, risk assessment. Now you see how the money flows. Now you understand the times, you understand the taxes, you understand the key personnel, you have the visual chart, you've got all the information. What can go wrong? Not what will go wrong, but what are the chances this is going to close, that is going to fail, that is going to increase the fees? What happens if all of a sudden that is a war there is a problem there? This is how you build contingency plans. You understand the risk and you have a comprehensive risk assessment, not just one company, one bank account, but the whole group, to even understand how to reroute the transactions. And obviously the 8 step, ongoing monitoring and evaluation, because whatever was good on a Monday might be the worst decision for you on a Tuesday. Your company is changing, the fintech industry is changing, new technologies are coming, new wars are erupting, unfortunately, new sanctions are coming, new dangers are there. You always need to monitor and evaluate what is the best contingency plan for your risk and for your setup as of today. And this changes. Regulation is changing. Everything is changing. So do a regular evaluation because it's super important. And we reached the last point, which is okay, who is going to do this all, right? It's not like your CFO is sitting and doing nothing anyway. Why not smack this extra responsibility on that person? You do need to have an independent senior figure who sees everything what payments and banking affects today, because as you know, payment and banking today impact the customer experience checkout, the risk management, the technology, what are we integrating, the data security, the product development, the compliance, the finance, so everything in the operation. So there has to be a strategy which is an essential element of the business strategy. It has to be considered as a standalone function and not just something that your finance deals with, because finance has never been trained or even on the basics, like what is open banking, what is crypto, what are sanctions, right? So your poor little accountant, CFO, CEO, or whoever is making decisions on payments and banking at the moment are just not trained to do so, because currently there is no training. Everybody is doing it based on a gut feeling, because key areas like how payments and banking affect all these parts that we mentioned, the UX, the compliance, the technology, it's completely absent from all the accounting and economic courses and even MBAs. We are the only and the first ones who are bringing EU certified education in the field, but it's still not enough. There is no coherent standards. There are no coherent certificate. Someone is making decisions over payments and banking who is completely uneducated to do so. They are doing their best, bless them. Of course, everybody is trying to figure it out through Google. But how safe is that person making decisions based on education they gained on Google over the years? Where are the gaps? If I say payment gateway, do I mean the same thing that your person might understand in the same? No, because there are no standards, there are no best practices or frameworks. So what we argue is that there has to be one person who understands a bit of technology, a bit of compliance, a bit of product, a bit of finance, a bit of legal, a bit of everything, because that person needs to make senior level decision how these interdependencies are affecting each other in an organization. And that person is the chief payment officer. Because today payments and banking require their own dedicated ownership, and the standardization is long overdue. So we see more and more companies are coming up with this concept of the chief payment officer, which lives through different departments, the product, the finance, the risk, the tech, the compliance, but it also has a very important part in various stages of a business life. In the startup, as you ask for a legal advice, as you try to use your basic documents, your internal documentation made by professional lawyers, have a professional set up your payment systems as well, because maybe it's not scalable, maybe you're overpaying, maybe in the startup phase, because you are high risk anyway, because you're a startup, you don't have volume, you're not really desired by banks, you need a person who is guiding you how to set up things to be scalable and long-term maintainable. But it's also very important in a scale up phase when everybody is already doing things. There is still no person or group of people who are appointed with this function, taking care of a payment and banking alone. And that's when we see that someone is putting up the hat because someone has to deal with it. But that could be an administrator, that could be your CFO, that could be maybe even a random developer who realized that, okay, guys, we just need to make sense of that. And management don't even know how important that person's job is. In scale ups, we see that there is a CPAO, we just don't name them. And this is a big, big risk. And of course, in large companies, the CPO is getting very important because in large companies, don't rock the boat. We use this bank for 20 years. We haven't renegotiated our fees for 20 years. That's when you're losing the most amount of money because things are not being paid attention to. And this is a huge problem. So the CPO in the various stages in business life can make a lot of difference. And in cases like that, that CPO should take the responsibility to make decisions relevantly. So it is very important that we have the contingency plans. We have the person who understands everything within a business, who is making the relevant decisions, who has the seniority and has the experience. And hopefully, very shortly, we will also be able to say that they have the relevant education and certification to make those decisions. So those are the points that I wanted to bring to you, and I would be really curious about your comments and questions. What are your fears? What are your thoughts about what we have discussed? So I would like to encourage everyone to please leave your comments, your questions, your add-ons, and let's have a discussion for the remaining time of why do you think that we need to actually, why do you think we need to talk about, of course we need to talk about this, but how does it affect you personally, all these uncertainties when it comes to wars and sanctions and disruptions, and do you actually have the relevant contingency plan? Have you ever actually thought about renegotiating your fees or checking your money routes? So let's see those questions. Peter says, will compliance team need to tighten KYC AML screening for cross-border payments linked to the conflict region? They don't need to, they have to. And it might actually end up really bad when it comes to you. And this is a bad thing because every time that there is a conflict, there is a war, there is looting, there are politically involved people who are taking corruption money, there are monies go missing, there are investments which are undocumented in case of there is some issues. There is always a problem. So when we are talking about areas when there are disruptions, civil war, attack, documents missing, data centers going to flame, yes, KYC AML policies will need to be tightened. And it's super important that anything which is originating from the conflict region is double checked. Peter also asks, are fintechs and payment processors in Dubai prepared for sudden regulatory tightening? Could conflict drive increased demand for compliance, expertise, and payments training? Yes, but it's not only in Dubai. It's the whole Emirates area, is the whole Gulf area, really. Whoever is involved in this very unfortunate conflict. But what we see that, unfortunately, today, wherever we look, that there is a conflict. There's a conflict in Africa. There's in JCC area. There's Asia. There's Russia. There's Ukraine. Europe is wobbly on its own. So what you can do as a business owner, have a look at things, see where your money is kept, talk to your bankers, talk to your payment providers, create alternative routes, appoint a chief payment officer whose job is to monitor things and make decisions as it's needed. So you are not reacting, but you are preparing, because reaction in panic always has issues and always have problems other than benefits. And to be honest with you, I have seen many times that people are making decisions on a rush, and usually those are the worst decisions. Don't worry, there is a war. Put it through crypto. Like the worst advice. There are no traces. Sometimes, capital controls are crossed because someone's good advice is that put it through crypto and an unregulated exchange, and therefore we can just play around the banks. Wrong, wrong. If you cannot send it through the bank, there is a reason why. And if someone is offering you to bypass the banking regulations, you should be very afraid to take that route, because most probably it's not the right one. Yes, legally you might be able to do that, but it doesn't mean that you will be able to actually use those funds even if you moved that. So always talk to a professional, because these friendly advisors, don't worry, I know someone who knows someone who can bypass banking and KYC and AML regulations, is always a red flag. So if it's too good to be true, it usually is. So try to rely on professionals. Otherwise, you might find yourself either in jail, or your funds might be frozen or blocked with for all the right reasons. You shouldn't do things like that. Anisha is asking, in your experience, how many companies actually have a real contingency plan if bank suddenly freezes or closes their account? Not a lot. And this is bad. And this is exactly why we need to talk about these things, because it's super, super important that you have it. Just because other companies don't have it and you have it, you're already in the top 5%, I would say, who is even thinking about it, and not even mentioning the risk that you're eliminating. Just think about all those costs. When you go back and renegotiate your fees, when you see what are the alternative options, when you see how you can speed up the payment flows, that alone can save so much. And when things go south, when we see now, it's like when the mud hits the fan, that's at least when you're a bit more prepared, and you are not making these panic decisions. Oh my god, I need to get my money out. And you can actually make better decisions, because okay, we practiced for this. I didn't expect this to come, but at least I know what to do, and that can save a lot of headache and cost and risk in the long term, if you know what to do. You're not acting out of panic. Hanisha is also asking, if a company relies heavily on one bank or processor, what is the first practical step to reduce that risk? Well, don't. And I know you've got the volume discount. The more you process with one bank, the more they like you. They want you to spend all your money, keep all your money, use all the services within that one bank, of course, because then you're the best customer, right? They don't, they need to do one KYC check on you when the money is just coming. Is it the best for you? Definitely not. You always need to see how to diversify your risk. Not it, there is no bank in the world which is like super secure and super safe. And I'm not saying that okay, one bank goes belly up, the other won't, but at least you did everything in your own interest to at least try to minimize. Why it's important today. We are living in an environment when everything goes global. You have the opportunity to open bank accounts in foreign countries you haven't even been. Take advantage of that, because it can make a huge difference between uh, losing money, wasting time, spending cost, and actually not. So I think it's important that the first practical step to stop relying heavily on one bank or payment provider, basically. Peter is also asking, what investment should bank prioritize now? Technology, compliance training, or payment infrastructure to remain resilient in the conflict escalates further? Yes, yes, and yes. There is no one more important than the other, because technology is just as important as compliance training, just as important as the full infrastructure. Banks should also listen to this and ask themselves the question that, okay, what are our alternative routes? What are our alternative payment methods? What is our escape in case something goes wrong? So banks are just as international companies like any other company. They're just dealing with money, but they also rely on the correspondent and intermediary bank connections globally, and they also need to optimize, and they also need to do the contingency plan. So it's like super, super important that they also treat this as urgent, and remaining resilient in the conflict. Yeah, you can just hope that things end as soon as possible. But yeah, diversification is the key. Don't keep all your money in one currency, in one bank, in one country, even in one area. And then you just need to balance out that how much you pay versus what is the risk that you're eliminating. Peter also says, let's be honest, if sanctions expanded tomorrow, would most banks actually be operationally ready, or would compliance teams be scrambling for weeks? Scrambling for weeks and even months, because I have seen that when the sanctions were introduced, a lot of interconnectedness is going on in the background. We can say that from now on, this country is sanctioned, but how many transactions are going through that country, how many activities that country is involved in, and the source of fund might come from that country. So just by putting one area or country or group of people in the blacklist, you have a ripple effect in countries which have nothing to, officially on the surface, nothing to do with that country, but there are a lot of underlying interdependencies. And that's what I think that we don't really talk about a lot. As we mentioned, for example, you wouldn't be able to send money to Kazakhstan because the Russia had the intermediary banks, and I was sanctioned. So there are a lot of interdependencies and interoperabilities and connectivities in the background that you might not even think about, but now we are mentioning it. It's actually a good idea to ask this, and yeah, try to set up a resilient payment and banking plan. Could real-time payments and tokenized currencies actually reduce exposure to geopolitical risk, or do they create new blind spots? Again, yes and yes. They do exposure geopolitical risk. So what we have seen, for example, um, in crypto, a lot of countries were afraid that they are imposing capital controls and the people are siphoning money out of crypto. Like, there are capital controls for a reason. You agree with it or not is a whole different question, but there is a law, there is a legal requirement that you have to keep. And if you are not allowed to send money out of the country, you shouldn't be able to do it through crypto, gold, chickens, whatever the choice of payment value. But that can undermine the efforts while the country set up the capital controls at the first place. And yes, it does create new blind spots because there are also new regulations which will have to be introduced. There has to be documentations change, procedure change. From now on, we don't take, or from now on, we check this as well. Extreme measures. You need to take new documentation. You need to train the team. You need to have monitoring in place. So it costs a lot, takes a long time, and could be a serious headache. So yeah, that could be definitely an issue. Do compliance and operation teams have enough practical training to respond to rapid escalation, or are we relying too heavily on tech? We are relying heavily on tech, and I'm telling you something worse. We are still relying on our gut feeling, and I'm just leaving it there. How many payment and banking and fund decisions you as the viewer, out of gut feeling, not because you know that, okay, I know how it works and I have all the information, I'm making an informed decision. It is about gut feeling. And this is what I'm arguing against, that you do need to have standards, you do need to have education, you do need to have certified knowledge where the government backs it up. For example, our trainings are EU certified, and the trainings that we run has the Dubai Knowledge Hub logo as well. So it's government backed, because there has to be some kind of unified education, certified best practices, ways to do things. Otherwise, things are getting more and more complicated. And nowadays, in this world, when tech is evolving with the speed of light, and we've got regulation and fragmented regulation, whatever is allowed in this country is illegal in the other country. A lot of confusion and a lot of problems. It is your money, it is your responsibility. You make a message, decision, you make a mistake, you are going to pay for it. And I have seen so many times that monies are going to waste just due to inefficiencies, just because you keep millions on one bank account and oops, what something happened with it doesn't need to be like something happens with the bank. The bank is losing one of your document. By the time you send the document, the account is frozen. Stupid things like this. You do need to ask those questions of why am I making certain decisions? And unfortunately, more often than not, because it feels right, it shouldn't be like that. It's money. It has to be standardized. We have to have education, certified education around it, and that is just so important that I can't highlight this enough. How important is that? And Peter is also asking, where are the biggest gaps in knowledge when it comes to cross-border payments on the geopolitical stress? Is enough being done to upskill staff on new payment technologies like tokenized currencies, real-time settlements, and digital assets? I think we need to go back to the root. What is a bank? What is a payment provider? What is an acquirer? What is open banking? What is regulation? What is AML? Like, even the basics are not in place in so many heads. And you would be surprised how many people are making decisions over payments and banking who don't even know the basics. And again, I'm not blaming them. They are doing an amazing job. They're trying to figure it out without having any information on that. And somehow it's working. So the guys are doing a good job, but it has to be a better way. There has to be informed decisions made. There has to be a trusted, independent body who is not trying to sell you something. It's not like you're relying on someone who says, yes, I have a solution for you, just to earn commission out of it. There has to be an ethical way. So the biggest gaps is even with the basics, like what is integration, what is API. Usually finance people don't know that. Or if you're going to, for example, to the compliance teams, they won't be able to say what is an iframe, or how the customer service is affected by using different payment methods. Like, what is a chargeback, what is payment data, what is a bin, right? So these are those informations which need to be concentrated in one hat, who is then understanding everything else where the payments and banking is related to, but it's still not. And that is the reason that we are arguing for the importance of the chief payment officer, because you can't expect a finance person on the finance training to have full understanding on APIs and technology and product development and customer service and compliance and what is legal and what is not. It is a lot of work to smack on finance. And as I said, doing making decisions on a guesswork is never a good decision. So education is very important. Understanding that there is a problem is very important. Do not panic react. Do not make decisions under pressure, because that's when you're making a lot of mistakes. And if this summary helped, if you had any information out of it that you didn't know before, then please share it with your peers. I think in this case, it is very important that we at least talk about the problems. At least we start paying attention to certain things. At the end of the day, it's your money. It is your responsibility. It is your decision. So try to make the best decision as you can, and obviously work with professionals. Relying on people who are not educated or not trained on certain aspects is not going to get you closer to your goal, and oftentimes it's getting you away more than anything. So please share this with your peers. Comment on the video. It's very easy to find us. So just please get the comments going. Let's keep on the conversation. Reach out to us. Let's have a brainstorm. Let's figure out what is your issue and how to find a solution for your problem, and keep talking about the problem. And together we can actually build a transparent and ethical industry. We can do those standards. And it is very, very important that that we at least start the conversation. So please reach out to us. We have a lot of free content, webinars with experts, with industry leading experts about the latest gossips, technologies, solutions, hints, tips about payments and banking. So please visit our website as well, which is the shortaginstitute.com. You see a lot of content there, but please follow us on social media. We are always active on LinkedIn. Please reach out to us. Questions, comments, notes. Please do that because we are here to help you and eliminate your panic and last minute decisions as well. So please don't be a stranger. Keep on the conversation going. And thank you very much for joining. And good luck. Stay strong. And I hope the situation de escalates as soon as possible. And we don't even need to talk about these things. So thank you. Have a great weekend and see you soon.